I'm Alan Kenny, Editorial Director with REIT.com, and we're in New York for REITWeek 2014, NAREIT's Investor Forum at the Waldorf Astoria Hotel. Joining me is Joel Bean, Portfolio Manager with Forward Management. So Joel, your fund focuses specifically on REIT preferred stocks. Can you give us an idea, what are the specific attributes of these stocks that investors kind of embrace, and how do you expect they're going to perform for the rest of the year?
Well, I think what's attractive about the preferred market for investors is the opportunity to trade off a higher total return for more of an income-oriented return. You get more safety and more income as you go up the capital stack. So you don't make as much as you should make, with common stock, because you're not taking the kind of risk that a common equity investment takes. But in general, it's been a really good value proposition. Given where we are priced right now, which is, the yields are in the sort of high sixes and low sevens in some cases, I think that if we're able to sort of maintain pricing, that's probably the kind of return we're looking at. If for some reason rates drop a lot or spreads contract, you could see a little elevation in the return outlook. But I think, a mid-single digits type of return is probably what's priced in right now.
So can you give us an idea, the sector breakdown that your fund is using right now, and maybe if you're looking at any shifts there?
Sure. Well, the fund focuses on preferred, but it also has common stocks in it, I should just point out. So we look at it kind of on a fully diluted basis of how we're exposed. And the preferred market as well as the common market provides a lot of opportunity to diversify your investments across property types. So by property type, by issuer, by underlying geography, you can really assemble a portfolio with great diversity, and that's what we always intend to do. With that said, we do pivot the portfolio to try to take advantage of momentum or increasing strength, either on the credit side or literally as an equity investment in certain sectors. So for a couple of years now, we've been sort of believers in a slow recovery, a frustratingly slow recovery. And we've been gravitating the portfolio to try to take advantage of shorter lease duration. So that puts us in apartments and hotels a little bit, more prominently. The other thing that we've been doing lately is being a little bit more contrarian and allocating toward office companies, particularly suburban office companies. And the reason for that is it's a really tough business. But right now it's sort of priced for the toughness. And if you really are optimistic as we are about things getting better, albeit slowly, we think it's worth considering. So we try to be a little bit unpredictable and risk embracing in that sense.
And so REITs right now, in terms of their valuations, are they undervalued, fairly valued, overvalued?
Well, that's the $500 billion question. Our view is that they're pretty fairly valued, both on the common and the preferred side. It's pretty fairly valued for our current environment. What we're most worried about is the landscape shifting. In the current landscape, I think REITs, provide the opportunity for a high single digits return, and for the preferreds, it's some number, maybe a couple hundred basis points inside that. But what we've spent a lot of time thinking about is what we call exit multiple risk. We're just worried about the landscape shifting, and that's if there's one thing that keeps us up at night, that's what it is.
All right, well, thank you so much for your time.
Thanks for having me, Alan.
And for more on this and other REIT news and analysis, be sure to visit REIT.com.